Assalamualaikum and hi, my name is Aina Safa Binta Rashid and my fellow friends Nordin Zafira, Asmita and Nur Yuhani Sabrina. Our team members will present about an audit of the inventory and warehousing cycle.
We will start with Introduction to Audit of Inventory and Warehousing Cycle. The inventory and warehousing cycle is unique because its close relationship to other transaction cycles such as sales and purchasing cycle. Auditing this cycle is often the most complex and time-consuming part of the audit for these reasons. The first one is inventory is often the largest account on the balance sheet. Inventory is often in different locations. It makes physical control and counting difficult. Diverse inventory items such as jewels, chemicals, and electronic parts are often difficult for auditors to observe and value. Valuation is also difficult when estimation of the inventory obsolescence is necessary and when manufacturing costs must be allocated to inventory. And the last reason is there are several acceptable inventory valuation methods. There are 6 business functions in the cycles and there are also a few related documents and records for each 6 functions. So the 6 functions is, the first one is process purchase order, second, receive raw materials, third, store raw materials, fourth, process the goods, fifth, store finished goods, and the last one is ship finished goods. Perpetual Inventory Master File. Perpetual Inventory Master File is updated continuously as raw material move from storeroom to production as we buy the material. Includes information about the units of inventory acquired, sold, and on hand, and often includes information about the unit cost. Separate perpetual records are likely to be kept for raw materials, work in process, and finished goods. There are 6 functions in the inventory and warehousing cycle. The first one is process purchase order. There are 2 related documentation relate with the first function, which is purchase requisition and purchase order document. Next, the second function is receive raw material. Receive raw material is also the first flow of inventory. This function need 2 related documentation, which is receiving report and vendor invoice. Next, for the third function is store raw material. Under store raw material, it's related with the second flow of inventory, which is put raw material in the storage. Store raw material need 1 related documentation, which is raw material inventory perpetual master file. Next, the fourth one is process the goods. Under process the goods, there are 2 related documentation, which is purchase requisition form and cost accounting record. Under this function, it's also related with the third flow of inventory, which is put material into production. Next, the fifth function is...
Hi, my name is Nordin Zafira and I'll be explaining the 5 parts of the audit of the inventory and warehousing cycle. Audit of the inventory and warehousing cycle can be divided into 5 activities within the cycle. The figure shown summarizes the 5 parts mentioned. Because of the interrelationships between this cycle and other cycles, some parts of the audit is most efficiently tested with the audit test of audit cycles. In the figure, auditors test the first activity of the cycle as part of the audit of payroll and personnel cycle and acquisition and payment cycle. They also test the shipment of goods and recording of revenue and related costs in the sales and collection cycle. Thus, two parts of the audit of inventory and warehousing cycle are audited by analytical procedures and tests of details of balances. The first three parts of the audit of inventory and warehousing cycle is tested using the same method as the other cycles, while the rest are explained in this chapter. We'll discuss the audit of cost accounting. Our discussion on this section starts with the transfer of assets from raw materials to work in progress to finished goods inventory. We will also focus on the systems and controls of the transfer of inventory costs. Cost accounting controls are those related to the process affecting physical inventory and tracking of related costs from the time raw materials are requested, the time manufacturing of the product is done, and its transfer to storage. There are two broad categories of control. First one is physical controls over raw materials, work in process, and finished goods inventory. One of the useful control is having the perpetual master files maintained by persons who do not have custody of or access to the assets. Test of cost accounting, the auditor is concerned with four aspects of the cost accounting. The aspects of physical controls over inventory, documents and records for transferring inventory, perpetual inventory master files, and unit cost records. The first aspect, what should be done? First is to physically segregate and restrict access to storage areas of raw materials, work in process, and finished goods to control the movement of inventory. Next, approved and pre-numbered documents must be used for authorizing movement of inventory to protect the assets from improper use. Electronic or paper copies of these documents should be sent directly to accounting by the persons who issued them, bypassing people who have custodial responsibilities. What would auditor do? Should examine raw material area. They need to ask custodian to explain their duties to the oversight and monitoring of inventories. If he finds it poor, more work or time will be needed for the physical count. The aspect is an auditor's primary concern. It is to verify the transfer of inventory from one location to the another. All transfers are recorded, all transfers exist, the quantity and descriptions are accurate. At present, a barcode plays a major role. Auditors need to understand the internal controls before performing tests of transactions and test controls. Example, review sequence of raw material acquisition, determine whether it is properly approved, compare the quantity, description, and date with what is recorded in the master file. Compare completed production records with the master file to make sure all finished goods are transferred to the ending inventory. For the perpetual inventory master file, its reliability affects the timing and extent of the audit. If it's reliable, count can be done before the end of the year and the control risk is set to low. Auditor then examines documentation to support the addition and the reduction of raw materials, work in process, and finished goods. One thing to remember is for raw materials and finished goods sold, testing are done during acquisition and sales cycle. If perpetual inventory is computerized and integrated, the auditor will test its computer control to reduce control risk. Accounting for direct labor, direct materials, and manufacturing overhead should be accurate to ensure a fair representation of raw materials, work in process, and finished goods. Accounting should be integrated with production. Auditors must understand the internal controls, which is part of the acquisition and payment cycle, payroll and personnel cycle, and sales and collection cycle. For direct materials, they need to trace the unit cost and unit of addition in raw perpetual inventory system. For direct labor, they need to trace summary of payroll directly to the job order cost sheet. In manufacturing overhead, they need to consider the reasonableness of allocation method and whether it is consistently applied. If direct labor is used, it is easy for the auditor because he has completed the payroll and personnel cycle. If machine hours is used, then the auditor has to examine the client's record of machine hours.
I'll present substantive analytical procedure. Analytical procedure is the study of relationship or data between various figures, ratios, horizontal analysis, vertical analysis, and so on, looking for unusual fluctuation or relationships for further investigation. Analytical procedures are performed at 3 stages of audit. First, beginning of the audit, which is risk assessment procedures. Second, during audit, which is optional as a substantive step. Use judgment, extent depends on stability of numbers. And third, end of audit, which is financial analytical procedures. Next, we go to analytical procedure for the inventory and warehousing cycle. First, analytical procedure is compare gross margin percentage with that of previous years. The possible misstatement here is overstatement or understatement of inventory and cost of goods sold. Second, compare inventory turnover, which is cost of goods sold divided by average inventory with that of previous years. The possible misstatement is obsolete inventory, which affects inventory and cost of goods sold, overstatement or understatement of inventory. Third, compare units of inventory with those of previous years, overstatement or understatement of units cost, which affect inventory and cost of goods sold as the possible misstatement. Next, compare extended inventory value with that of previous years. The possible misstatement is misstatement in compilation, unit cost or extension, which affect inventory and cost of goods sold. And lastly, compare current year manufacturing cost with those of previous year, which is variable cost, should be adjusted for changes in volume. The possible misstatement is misstatement of unit cost of inventory, especially direct labor and manufacturing overhead, which affect inventory and cost of goods sold.
Next, we will talk about how to perform physical observation audit tests for inventory. Basically, auditors have been required to perform physical observation tests of inventory since a major fraud involving recording of non-existent inventory in 1938 by McKesson and Robbins scandals. Start by touring of the client's inventory facilities, including receiving, storage, production, planning, and record-keeping areas to gain understanding. Then, they assess the client business risk of material misstatement. Examples of common sources of business risk for inventory include short product cycles, potential obsolescence, use of just-in-time inventory, reliance on a few key suppliers, and use of sophisticated inventory management technology. After assessing client business risk, the auditor determines performance materiality and assess inherent risk for inventory, which is typically highly material for manufacturing, wholesale, and retail companies. Why? Auditors often assess a high inherent risk for company with significant inventory, depending on the circumstances. Auditors often have a greater concern for misstatements when inventory is stored in multiple locations. The costing method is complex and the potential for the inventory obsolescence is great. Auditing standards require auditors to satisfy themselves about the effectiveness of the client's method of counting inventory and the reliance they can place on the client's representations about the quantities and physical condition of the inventories. To meet the requirement, auditors must be present at the time the client counts its inventory. observe the client's counting procedures, make inquiries of client personnel about their counting procedures, and make their own independent test of the physical count. An essential point in the auditing standards is the distinction between who observed the physical inventory count and who is responsible for taking the account. The client is responsible for setting up the procedures for taking an accurate physical inventory and actually making and recording the counts. The auditor is responsible for evaluating and observing the client's procedures, including doing test counts of the inventory and drawing conclusions about the adequacy of the physical inventory. What if inventory is housed in public warehouse? Generally speaking, no need physical examination is needed. Auditors verify inventory by confirmation with custodian. However, if inventory stored with outside custodian represents a significant portion of current assets or total assets, the auditors should apply additional procedures, which is review custodian inventory procedures, obtain an independent accountant's report on the custodian control procedures over the custody of goods, or observing the physical count of the goods held by the custodian if practical. For controls over physical count, regardless of the inventory method, the client must make a periodic physical count of inventory. The count may be done at or near the balance sheet date or at an interim date. Adequate control over the client's physical count of inventory include: first, proper client instructions for the physical count. Second, supervision by responsible company personnel. Third, independent internal verification of the counts by other client personnel. Fourth, independent reconciliations of the physical counts with the perpetual inventory master files. And the last one is adequate client control over count sheets or tags used to record inventory account. If the client's physical inventory count controls are inadequate, the auditor must spend more time to make sure that the physical count is accurate. Under audit decisions, the auditor must make some decisions regarding the observation of the physical inventory count, which is timing, sample size, selection of items, and physical observation test. First, for timing, the auditor must decide whether the physical count can be taken before year end if auditor is satisfied that internal control over perpetual inventory working effectively. Test transaction recorded in the perpetual inventory records from the date of count. Compare perpetual inventory number on a sample basis. If IC over perpetual inventory, then count as a year. The number of items to count is difficult because the auditor should concentrate on observing the client procedures, total number of hours spent, not number of items in inventory. Numbers of hours is a factor of adequacy of internal control, dollar amount, type of inventory, location of inventory, and nature and extent of errors or misstatement found in the previous audit. Proper planning is required. observe while they are counting. The third one is selection of items. Under selection of items, when auditors observe the client counting inventory, they should be careful to observe the counting of the most significant items, inquire about items that are likely obsolete or damaged, discuss with management the reasons for excluding any material items. For the last one is physical observation test. Balance-related audit objective for inventory are similar to those for other cycles. So, let's review common tests of details of balance audit procedures for physical inventory observation.
The first balance-related audit objective is inventory in the inventory listing schedule agrees with the physical inventory counts, the extensions are correct, and the total of correctly added and agrees with the general ledger, which is detailed tie-in. The procedures are, firstly, to perform compilation tests, such as see existence, completeness, and accuracy objectives. Second, put the inventory listing schedules for raw materials, work in progress, and finished goods. Third, trace the totals to the general ledger. Fourth, extend the quantity times the price on selected items. The comments is, unless controls are deficient, extending and footing tests should be limited. The second balance-related audit objectives is inventory items in the inventory listing schedule exist, which is existence. The procedures is trace inventory listed in the schedule to inventory text and auditors recorded counts for existence and description. The comments are, the next 5 objectives are affected by the results of the physical inventory observation. The tag numbers and counts verified as a part of physical inventory observation are traced to the inventory listing schedule as a part of this test. The third balance-related audit objective is existing inventory items are included in the inventory listing schedule, which is completeness. The procedures are account for unused tag numbers shown in the auditor's documentation to make sure no tags have been added. Second, trace from inventory tags to the inventory listing schedules and make sure inventory on tags is included. The third, account for tag numbers to make sure none have been deleted. The fourth balance-related audit objective is inventory items in the inventory listing schedule are accurate, which is accuracy. The procedures are trace listed in the schedule to inventory tags and auditors recorded counts for quantity and description. Second, perform price test of inventory. Figure 21.4 shows the interrelation of various audit tests. Firstly, in order to calculate raw materials, there is also test of acquisition and payment cycle in formula, which is beginning inventory plus acquisition of raw materials minus any inventory. Any inventory is calculated by using inventory tests, such as test if cost accounting record, test of physical inventory observation, and test of pricing and compilation. In order to calculate work in process, the test of payroll and personnel cycle is used to calculate direct labor and indirect labor. The formula to calculate work in process is beginning inventory plus direct labor plus raw materials used plus indirect labor and other manufacturing overhead minus inventory, which equal to cost of goods manufactured. Cost of goods manufactured used to calculate finished goods, and the formula is beginning inventory plus cost of goods sold plus cost of goods manufactured minus any inventory equal to cost of goods sold. Test of sales and collection cycle also used to get cost of goods sold.